In this video, we introduce 3 new chapter concepts, and they're all rather simple concepts. The first is the use of an optional manufacturing overhead control account. Instead of a single manufacturing overhead account, we will have 2 manufacturing overhead accounts, a manufacturing overhead control and a manufacturing overhead applied account. The allocation of under or over applied manufacturing overhead to work in process, finished goods, and cost of goods sold. Traditionally, we've only closed out that manufacturing overhead to cost of goods sold. Now we will consider prorating it between 3 accounts, work in process, finished goods, as well as cost of goods sold. And the third concept is the use of subsidiary ledgers to record the accounting for work in process, finished goods, cost of goods sold, and we would also use this for recording sales and receivables as well. Let's go ahead and take a look at that first chapter concept, the use of manufacturing overhead control account. So in the past, we used a single manufacturing overhead account, and we had actuals being recorded on the left-hand side of the T account, and applied manufacturing overhead credited to the right-hand side of the T account, and of course that flows into work in process. When we introduce a manufacturing overhead applied account, we simply separate that manufacturing overhead account into 2 separate accounts. The control account is where we record actual manufacturing overhead, and we apply manufacturing overhead using the applied account. Notice the credit to applied and the debit to work in process. We might think about using this in the situation where we incur actual manufacturing overhead costs, and then for some reason we have a reduction in those costs. We've made a mistake, we have a credit from a vendor. Well, that would appear as a credit to manufacturing overhead. So if we want to segregate every single credit that relates to the application of overhead to jobs, we are going to set up that separate account. So when we credit manufacturing overhead applied for particular jobs, it happens in the manufacturing overhead applied account. Whereas if we had a credit or a reduction in our actual manufacturing overhead, that would happen in our control account. Again, this is an optional treatment that just gives us a little bit more information about what's going on in our manufacturing overhead account. The next concept we'll take a look at is the allocation of over or under applied manufacturing overhead to work in process, finished goods, and cost of goods sold. So a proration of our under or over applied manufacturing overhead. Traditionally, again, if we have our manufacturing overhead control of $40,000 and $50,000 in applied, we need to close out our manufacturing overhead an additional $10,000 debit to manufacturing overhead. And we would debit manufacturing overhead, of course, and credit cost of goods sold. And again, we do this because we need to zero out manufacturing overhead, and by applying $50,000 when actual overhead was $40,000, that would have made work in process too high by $10,000, finished goods too high by $10,000, cost of goods sold too high by $10,000, and so this journal entry reduces our cost of goods sold by $10,000 and closes out manufacturing overhead. But rather than closing the entire amount out to cost of goods sold, we can consider prorating it between work in process, finished goods, and cost of goods sold. We'll take a look at some problems later on how to do this. Let's just go with a rather arbitrary allocation. We might allocate 70% of it to cost of goods sold. In other words, 70% of our jobs have flowed through all the way to cost of goods sold. We could allocate 20% to finished goods. In other words, the thought would be that 20% of the work we started this period is still sitting in finished goods, and perhaps 10% of the work we started is still sitting in work in process. So if 70% is flown all the way through to cost of goods sold, 20% remains in finished goods, and 10% remains in work in process, it makes sense to think about allocating this $10,000 in this case, over applied manufacturing overhead to all 3 accounts in relative proportions as to where those costs actually are at the end of a period. If the amount of under or over applied manufacturing overhead is a very small amount in comparison to our overall manufacturing costs, it might be easier just to say, let's just stick it all in cost of goods sold. It's that always present cost-benefit trade-off. Now let's go ahead and take a look at that third new chapter concept, the use of subsidiary ledgers for work in process, finished goods, and cost of goods sold. Typically, when we make a sale to a client or a customer, we do what? We credit sales and debit accounts receivable, although not really. The real debit is to accounts receivable, the Jones Company, or debit accounts receivable, the Paxton Company, or accounts receivable, Axiom. If we want to keep track of how much each one of our customers owes us, we need to use a separate subsidiary ledger account. And of course, all of those accounts receivable accounts add up to the total amount we show for accounts receivable on our balance sheet. So again, we don't really debit accounts receivable. We debit accounts receivable for a specific customer. The same is going to be true in our job order costing environment. When we incur costs on a job, we make use of subsidiary ledgers. In other words, we don't simply debit work in process for $50,000 when we apply our manufacturing overhead. Instead, we apply that manufacturing overhead to specific jobs. Work in process job A, work in process job B, work in process job C, and of course, the amounts that we record in those subsidiary ledgers will tie into our work in process account. The same is true when we transfer goods or jobs from work in process to finished goods. As we transfer the cost of job 1 to finished goods, we don't debit finished goods, we instead debit finished goods job 1, or of course finished goods job 2 and finished goods job 3. And all of those amounts tie up to our control account or parent account for finished goods. And we can do the same thing as we ship goods to customers. We will transfer the cost of specific jobs from finished goods into cost of goods sold. And again, those of course would come out of the relevant finished goods accounts as well. So notice the debit to finished goods, and we of course would debit cost of goods sold, but actually debit the various subsidiary accounts, which roll up into cost of goods sold. So those are the new chapter concepts: the introduction of an optional manufacturing overhead control account, the allocation of under or applied overhead to work in process, finished goods, and cost of goods sold, also referred to as a proration of that amount, and then of course the use of subsidiary ledgers. We'll see those throughout the chapter problems.